Sales of Toronto condominiums have gone down, and here are some of the reasons why. First one is obvious. Higher mortgage costs translate into higher monthly mortgage payments. For buyers, if payments are expected to be higher when qualifying for a mortgage, then it also means they're looking at properties of lower value. Buying a home becomes more expensive for purchasers, so their purchasing power and affordability are reduced. That stops a lot of buyers from getting into the market, and that's why we have a ton of condo inventory available right now. There are 1,700 active condo listings in downtown Toronto right now. They would take about 5 weeks on average to sell. The average price is about $805,000. There were only 80 condo sales transactions so far this month, and compare that to the monthly average of around 400 condo sales per month that we're used to seeing in a normal Toronto condo market. I looked back at every July for the last 20 years, and sales were consistently around 300 to 500 a month when there wasn't some sort of market correction happening at that time. Sales fell to around 250 a month last year in July 2023. We haven't seen sales this low since 2012, and it looks like we're on track for condo sales to fall even further. Keep watching and I'll tell you why. As mortgage rates went up, it became harder for potential buyers to qualify for a loan from the bank. Stress tests for mortgages already made things difficult to begin with, and that's only gotten worse. This reason alone is what might be holding back a large amount of potential buyers out there. They might have the funds for a down payment, monthly payments would be okay based on current rates, but qualifying for the rate and the purchase price is what's stopping them because of the mortgage stress test. If you're trying to get approved for a rate of, let's say, 5%, which is common these days, you would also have to qualify on your stress test at 7%. There's also the rule that you'd have to qualify at a rate of 5.25% instead of adding 2% to the rate you're trying to qualify at. But they take the higher of the two scenarios, and these days any rate you're trying to qualify at plus the 2% for the stress test is going to be higher than the 5.25%. And now lately, it makes sense why the banks are still doing the stress tests, which started in 2016. It's their way of protecting themselves against borrowers who could be at a greater risk of defaulting on their mortgages and cannot make their payments on time. So the test is more for the bank's peace of mind, since it proves if the borrower can afford payments at higher interest rates. Maybe a few years ago, this seemed a bit unnecessary, and now not so much. Many homeowners saw their mortgage rates go up by more than double over the last few years, to the point of not being able to afford their homes anymore, and this ends up with the bank taking over the property. Even properties like $500,000 or $1 million condos are at risk of being lost by homeowners if they can't make their payments, and some condos on the market right now are listed by the banks, adding to the supply of condo inventory available. Next is the reduced demand. Higher borrowing costs pushes buyers out of the market. Interest rates are not going up anymore. In fact, now they're on track to come down further this year. But before the first rate drop in June, rising interest rates led to potential buyers delaying their purchases. The hope was to see interest rates drop again, and they are, yet there's still hesitation in the overall demand in the market, because falling interest rates doesn't seem to be enough. Prices have to come down. With 1,700 active condo listings in the downtown area, that's maybe 40% more inventory than what we're used to seeing in a typical July. Eventually, the excess inventory amount will sell off, and we'll get back to regular levels of available condo inventory, which is around the 1,200 range. When we see supply back down, there's no reason for prices to go down. But until then, supply will remain high. We're in a slower economy. Higher interest rates didn't just have an impact on housing, they were put in place to curb inflation and slow down the economy. This also led to higher unemployment and reduced income growth, on top of lower consumer confidence in the overall real estate market. The lower confidence comes from not knowing what direction the market is headed towards. Are prices going to keep coming down, or are they starting to go up? Are interest rates going up, or are they starting to come down? And all of this economic change and uncertainty means that people would have less interest in moving and buying and selling real estate, since it becomes less of a priority. So the housing market takes a hit and homes stay on the market for longer. Condos in the downtown area are staying on the market for almost 5 weeks on average before they sell. We're still in a market correction. Even though we saw the first rate reduction in June of 25 basis points, we're nowhere near close to the finish line, which means that the market we're in right now is here to stay for a while. Sellers will have to continue to lower their expectations. Homes are not worth what they were a year ago, and some homeowners are finding that difficult to adapt to. If a seller's expectations have not adjusted, then this would likely lead to the property sitting on the market for longer, like we're seeing today. Downtown Toronto condos are sitting on the market for more than 5 weeks before they sell. There was a time when they'd sell in less than 3 weeks. There was a time when they sell in less than 1 week. Not being able to adjust to the current market can lead to a period of home prices falling or not moving at all, and that's what we're seeing with the current market. The average condo price this time last year was $815,000. Today it's closer to $805,000. The market correction that we're in also led to an overall overall economic downturn. We saw job losses and reduced confidence in the real estate market. People started to believe that Toronto properties and downtown Toronto condos weren't worth buying anymore. When people aren't sure about their job security and if they're going to be able to sustain their current lifestyles and home expenses with the possibility of no income, then they're less likely to put something like buying or selling their next home at the top of their priority list. It almost makes it impossible to save for a down payment of 20% and afford a new mortgage payment if job security is a risk. Canada's economy lost 1,400 jobs in June. Unemployment went up to 6.4%, the highest it's been in 29 months, according to the latest job market report from Stats Canada. This economic correction has impacted overall home prices, including condos in downtown Toronto. Prices are not going up as fast, and they're actually holding steady right now. The average price for a downtown Toronto condo is just over $800,000. And even though prices are not skyrocketing right now, that 800 grand is still the second highest average price we've ever seen in history in downtown Toronto when we compare year over year. The highest was last year. In July 2023, the average price was at $815,000. When you consider this plus where we are today with interest rates, then it makes sense why condo inventory can't move. Who is affording a condo downtown when interest rates are almost at the highest they've ever been? No one. Even if you could pull the trigger, would you? Many are saying no, and that's what's leading to the 1,700 active condo listings that we have available right now in the downtown area. They're not moving, and if they are, it's taking 5 weeks or more for them to sell. We're about halfway through the month and only 80 condos have sold. If only 80 condos sold, we're halfway through the month and there's about 1,700 condos still active in the market in all of downtown Toronto, then it would take more than 10 months for all of the condo inventory to sell. That's 10 months of condo inventory, which is another way of saying that there's way too much supply. This makes it a buyer's market, but it's not a typical buyer's market because this buyer's market is one that's unaffordable for now. Wait until we see more rate drops and we'll get into that intersection of when suddenly there are more buyers re-entering the market. July 24th is just around the corner, and that's when the next rate announcement is from the Bank of Canada, and chances are that the key interest rate might actually not go down another 0.25%, and instead it could stay at 4.75% until September 4th. The oversupply of condo inventory is leading a lot of buyers to think that home prices are still going to come down, and they might actually do that. If we have 1,700 condos for sale in downtown Toronto, when we're used to seeing a supply of about 1,200 or so, then it only makes sense that prices would come down if the sellers are motivated. And these days, sellers are motivated. If buyers believe that home prices will drop even more this year, then they might delay their home purchase while they wait for prices to drop to save a few bucks. So condo inventory continues to sit there even though there could be a qualified buyer out there. They're just not ready yet. But why are Toronto condos so popular to begin with? I'd have to say that it's because condos in the city have historically shown a huge amount of appreciation over time, making them an attractive investment for a lot of people. You could have bought a condo exactly 10 years ago for an average price of less than $450,000 in downtown Toronto. Today, that same condo could be worth almost 180% more. That's nearly $400,000 in equity in 10 years. That's like saying you got 40 grand in equity per year for 10 years, and all it took was a 20% down payment of $90,000 10 years ago. For doing one simple thing like buying a condo, it honestly doesn't get any easier to see the equity increase by more than 400%. Over the past decade, the Toronto condo market saw an insane amount of growth between 2011 and 2021. Condo values went up like crazy. This was driven by the trifecta of low interest rates, making it easy to borrow money almost for free, limited housing supply, and strong demand. This has a bit to do with the fact that Toronto's population growth has been a major driver in the real estate market. Even though we have an oversupply of condos in downtown Toronto right now with 1,700 on the market, the reality is that there isn't enough housing available for every family in the city. We have immigration from around the world and other provinces within Canada that's going to keep creating more demand, and that demand is almost always higher than housing supply available, meaning that there will be always more buyers than sellers. The correction we're in right now is causing a decreased demand, leaving the city with a ton of condo supply in the downtown area. Compared to a few years ago, we'd see condo sales in the range of around 400 or 500 selling every month. Now, we can forecast less than 200 for the month of July. That's a drop of about 71% in sales compared to the condo market that we're used to seeing. This has gotten a lot of buyers and investors thinking twice. Is Toronto still a good city to purchase real estate? Does it make sense to invest in Toronto condos in the downtown area anymore? Let me know what you think in the comments below. Eventually, population growth will continue side by side with consumer confidence coming back. That's only going to push prices back up. If you're considering only the short term, then I think the Toronto condo market is going to continue seeing a slowdown. Give it a few years and I don't see a reason why condo prices can't bounce back to prices higher than we've ever seen. They can fall in the short term like we've been seeing, but eventually eventually they just go right back up. We're in the middle of the year now and the market has cooled down compared to peak periods. The average selling price for condos saw a drop due to the higher amount of inventory that we have right now. It is so strange to see because buyers typically want choice, and they have choices now, but they either can't do anything about it or they're choosing to wait for prices to fall even more. The two scenarios are both possible, but just remember that long-term demand factors remain strong in the city and in the downtown area. So there's a strong potential for future appreciation and higher market values once the market stabilizes. Looking forward, I think the rest of this year is going to be a slow market with similar activity that we're seeing right now and also going into the new year. Come spring, new market, 4 or 5 rate drops could happen by then, and we could see a typical spring real estate market again. This means more competition, more multiple offers, and higher prices. The Bank of Canada should be careful with reducing the key interest rate too much and too quickly though. I think we need to see some changes with the key interest rate, but I don't think it needs to be so drastic. Sales are down, inventory is high, and yet buyers are not doing anything yet. They're not waiting for inventory. We have that. They're waiting for interest rates to drop. The Bank of Canada is making 4 more announcements to the key interest rate this year. Make sure to subscribe and stay updated. Thanks for watching, and I'll see you in the next video.